JSW Energy came out with numbers which was, well, you could argue on expected lines, actually slightly better than anticipated compared to the Bloomberg estimates. It was a healthy net quarter Q4. On expected lines, of course, for the year at large, too, the revenue numbers have done much better than the EBITDA numbers, arguably on account of higher fuel costs. And because of the acquisition that they've done, their net debt relative to their own standards has swelled up as well. So lots to talk about to Prashant Jain as he joins us at the end of FY23 and looking forward to FY24 and beyond. Prashant, great having you. Thanks for taking the time out.
Thank you, Neeraj, for inviting me.
No, the pleasure is ours. Now, Prashant, can I start off with the year at large first? Because it was a year wherein your capacity additions and your acquisitions probably shaped up as you have hinted through the year, but also a year wherein energy cost would have played spoilsport with most power producers. So how do you look back at FY23, and with all that you've done, what is in store for FY24?
So we did pretty well, actually better than expected lines. So last year, our capacity grew up by 44%, and we did very well in terms of the EBITDA also. On a operating EBITDA basis, this was the second highest EBITDA since the inception of the company, and for last 8 years, it is the highest operating EBITDA, highest operating profit. So it's a quite satisfying moment for all of us. And also, 2021, we started a large capital expenditure program, which is getting into the reality now. And going forward, what I see is that after we have, showcased this stellar performance of 3,820 crore of EBITDA, the year FY24, we will be 60 to 70% higher EBITDA as compared to FY23, and then FY25 EBITDA will be in a four-figure EBITDA. And you touched upon the debt. Last year, on 30th of March, we concluded the Mitra transaction. So the revenue has not come, whereas the debt has come. But on a pro forma basis, normalized EBITDA, our debt to EBITDA will be 3.4 times, and which is lower than our guided, policy of less than 4 times. So interesting time for the company, and then we are seeing better than expected cash flows and return ratios, and that's why we have articulated a strategy 2.0, which is better than strategy we crafted in 2021.
Okay. And I would love to know more about that as well, even though you may have spoken about it briefly. But before that, a couple of questions. When I look at your debt, right, and multiple ways to skin the cat, but when I look at the net debt to equity, I'm not saying it's worrying at all, right? Because your cash flows will, at a 1.2 or 1.3 times net debt to equity, your cash flows that will come in will easily service that. Relative to what you do, which is that you maintain a very tight ship on the net debt to equity side, it jumps up and then it cools off as well very, very quickly over the preceding next or the subsequent next 2-3 years. What is the outlook on that front?
So we are, we have not been growing our business from 2011 to 2021, other than only one acquisition, which we did in 2016 by acquiring the hydro business. So we have been primarily prepaying all our debt. And that's not the way the hydro business, the power business has to grow. So now what we are doing is levering up our balance sheet to an optimum level. So what is more important today, like we will be less than 1.5 to 1.8 times debt equity at all point of time, because we are a free cash flow company. Whatever cash we are generating, we are redeploying by levering up our balance sheet. And our debt EBITDA will be less than 4 times, and that's what we are guiding for. You need to look at that where, as compared to the industry, which is between 5.5 to 7.5 times debt EBITDA, we will continue to remain at less than 4 times. So this is how we will continue to maintain, and yet we will be growing our balance sheet much better than the industry.
Yesterday I was talking to Rajiv Jain of GQG, and he was saying that he hopes that infra companies and his investee companies, but otherwise as well maybe, don't pay off too much debt, because the opportunities in India are so large that it's better for free cash flow and longevity that debt is not repaid off but used very smartly, and assets are shored up. I'm guessing he's kind of echoing what you're just saying.
That's true. That's true. I think that's the size of opportunity is pretty large in this country. And in terms of the power space itself, in generation, the annual capital expenditure requirement is close to 2 trillion rupees, and 1 trillion is for the storage, and another 1 trillion for the transmission sector. So 4 trillion rupees capital expenditure every year. Of that, I'm targeting only 10 to 12,000 crore capital expenditure to grow my balance sheet, which is less than 2.5%.
Got it. Okay, you spelled out the numbers and gave us the size. Now, a word on EBITDA. I heard you say that the EBITDA numbers, of course, EBITDA hasn't come in while the debt may have come in. But I also thought that with the kind of jump in the fuel cost that we've seen, the EBITDA growth, of course, relative to the revenue growth was muted. Now, my question is, when you talk about the 60% or 65% or 70% growth in EBITDA in FY24 over FY23, does it hypothesize a corrective phase in fuel costs as well? Or are you confident that independent of what happens there, you would still be able to show this kind of growth in EBITDA that you just cited?
Yeah, nothing to do with the fuel prices, because all our businesses are pass-through business, and we do not account for very robust, guidance on the merchant tariffs. So whatever I'm talking about in terms of EBITDA, there are the upside risks, which is better merchant market or lower fuel prices. They will be kicking in higher EBITDA going forward. Otherwise, without that, also on a contracted capacity, I'm talking about this kind of improvements.
Got it. Just a word on what you reckon could happen to merchant pricing as well. Every company in the capex field that I speak to talks about the intent to up the capex, at least the larger ones. I've heard you mention in the past that because of the lack of capacity addition on the thermal side that India has seen, we could well see FY24 to be a year wherein the demand supply gets impacted fairly adversely. And does it have a material impact on power pricing in FY24 at some point of time?
You are bang on, and it's going to happen because last year, power demand grew 13 gigawatt, whereas the capacity addition, net capacity addition was around 4 gigawatts. So 9 gigawatt shortfall demand and supply side, because total capacity addition was 16.3 gigawatt. Of that, more than 15 gigawatt was renewable capacity. So it's a difficult spot for the country as a whole, but the government has taken various initiatives, but those are going to take some more time to fructify. So next 2-3 years will be a tight power market, because of which higher merchant tariffs. International coal prices are coming down, so we feel that it's a quite good opportunity for some companies who have open merchant capacity to capitalize upon. And so we'll look forward to capitalize on that in 2024, 25, 26. I think 3 years are going to be good for the sector for higher merchant tariffs.
Is that in part one of the reasons why a couple of notes that I read Prashant speak about how they see near doubling of earnings led by aggressive capacity addition at your end, and what could happen to maybe tariffs as you spoke? Just trying to understand, can you give us some color there about what do you expect the next 3 years? Then we'll come to 2.0 as well. But first, the next 3 years. And also, what are the recent acquisitions? How are they shaping up? What will they do in FY24 as well?
So whatever EBITDA improvement, I'm talking about capacity addition, I'm talking about all our contracted capacity. So I'm not factoring in any kind of a merchant pricing or other things. So those are icing on the cake, because they cannot be planned. And I'm not wishing that power prices to go up. I'm wishing that the sector should be vibrant, and then more and more investment should take place. So whatever we have done in last 2.5 years, there is a total capital expenditure program of around 21,000 crore, which we undertook, and which is getting completed by December 2024, and also around 10,100 crore of the acquisition we did. So there is a total capital deployment around 32,000 crore, which is fructifying and improving this EBITDA. We were generating close to 2,500 crore of free cash, which is going to go up to 3,500, 3,800 crore of free cash, which we are going to upgrade for our capital expenditure plan. Because we will lever it up by 1:3, and then we will deploy 12 to 15,000 crore rupees capital expenditure in time to come. That's how we are going to grow our balance sheet. So all these improvements are coming that way. In terms of the acquisition, what has gone by, I want to give you the color also. This is Mitra acquisition, which we did 10,150 crore for 1753 megawatt, which is specific invest cost of around 5.77 crore per megawatt, as against the replacement cost of today 7.5 crore per megawatt. This will be giving us a normalized EBITDA of 1650 crore, which is like 943 crore per gigawatt, which is close to 8 to 10% higher than the JSW standard of 840, 850 crore per gigawatt. So this is going to be substantially value accretive for us. The asset did last year 1,200 crore of EBITDA, and we guided that 1650 crore EBITDA will be achieved in 12 to 18 months time frame. But I'm happy to share in last 2 months, out of 125, 26 turbines which were down, we have already made 103 turbines operational. Rest all will be also operational in first week of June. So all the improvement plans are running ahead of schedule, and then we will be achieving that run rate much earlier in the current financial year. And that's why I'm talking about the EBITDA improvement plan, and the Ebitda growth will be much sharper than what we had anticipated.
Okay. Well, cross fingers for all of that. Prashant, my final question, 2030, renewable assets, hydro assets, solar modules, what have you, bunch of things happening there. Talk about 2.0.
So 2021, we came out with this strategy. We talked about that FY30, we will be a 20 gigawatt company. We will be having a 5x growth in EBITDA and 6x growth in profit, but we have upgraded that guidance by 25%, that we are talking now, along with 20 gigawatt of generation, we will have 40 gigawatt hour of storage up and running, as well as hydrogen of 3,800 tons, and 1 gigawatt of the solar PV panel manufacturing. Our capital expenditure program, which we talked about, 75,000 crore, has been upgraded to 113,000 crore, and our profit after tax will grow to 7.5 times as compared to 5 times. So this is what we are talking about. We are anticipating this while we are delivering our balance sheet as compared to the strategy we carved out, because we see healthier cash flows, and there are the upside risk on this strategy, because we have not accounted any equity dilution or the unlocking of the shareholder value in NEO. We have not accounted for lower interest costs, because we are seeing the peak of the interest rate cycle, and also these are P90 generation, and so any upside generation, and lastly, no merchant upside. So we are this. So I'm just trying to say that while this upgrade is coming, the estimates are very conservative, and we are going to do much better than that.
Well, we wish you all the best for that. Over the long term, we'll keep on talking to you about the short term, of course, during the course of the year. But thank you for taking the time out and giving us enough color on what could happen over the short term as well as the long term.
Thank you, Neeraj.
The pleasure was ours. Viewers, thanks for tuning in.